nations. There are no peoples. There are no Russians. There are no Arabs. There are no third worlds. There is no West. There is only one holistic system of systems. One vast and immane, interwoven, interacting, multivariate, multinational dominion of dollars.
Throughout recorded history, two monetary orders have competed for dominance. In one, the state, acting as the representative of the people, creates and issues the money supply as a public instrument of exchange, free of debt and interest. In the other, private banking interests are granted the privilege of creating money out of nothing and lending it at interest, extracting perpetual tribute from nations, governments, and individuals alike. This is what occurs all around the world today. Just think of the Federal Reserve in the United States, which was covertly slipped into the United States in 1913 and has since destroyed the value of the US dollar and created runaway inflation. The historical record, as we will see, is unambiguous. Every era of genuine broad-based prosperity, from medieval England, Napoleonic France, pre-revolutionary Russia, National Socialist Germany, Imperial Japan, and even Gaddafi's Libya, has coincided with a monetary system serving the public interest, and every era of chronic poverty, unpayable debt, and manufactured war has coincided with the reign of private banking. Today, I aim to show two interconnected ideas and their applicability today, that being the theory of social credit, as developed by the engineer and monetary reformer Clifford Hugh Douglas, and the historical case for state banking, as documented by former director of the South African Reserve Bank, Stephen Mitford Goodson, in his book A History of Central Banking and the Enslavement of Mankind. These two bodies of thought are deeply complementary. Douglas diagnosed the precise technical mechanism by which the existing financial system impoverishes society. Goodson documented the centuries-long historical pattern of that same impoverishment, and the remarkable prosperity that emerges whenever nations break free of it. Social credit, in its most fundamental sense, refers to the power of human beings working in association to achieve intended results. It is the latent productive power of a society, the accumulated inheritance of science, technology, culture, and cooperation that allows a modern industrial civilization to produce far more than any individual could produce alone. When capitalized as a proper noun, social credit refers to the study of this social power and to the political and economic movement that seeks to safeguard and increase it. The C.H. Douglas Institute defines it this way: social credit is chiefly concerned with the nature and functionality of association for the sake of economic ends. The economic system should allow for the fulfillment of the true purpose of economic association, the delivery of goods and services, as, when, and where required, with the least amount of trouble to anyone. The purpose of an economy, in social credit thinking, is not employment for its own sake, not perpetual growth, not the maximization of financial profit. It is simply to deliver goods and services to the people who need them, as efficiently as possible. Clifford Hugh Douglas arrived at his monetary analysis through practical observation. While working as assistant superintendent at the Royal Aircraft Factory of Farnborough during the First World War, he noticed something striking in the factory's accounts. The total costs of goods produced were consistently greater than the wages, salaries, and dividends paid out in the course of producing them. He investigated this across hundreds of firms and confirmed the pattern. There is, built into the structure of industrial cost accounting, a persistent gap between the prices of goods and the purchasing power distributed to consumers in producing them. Douglas called this the A plus B theorem. In simplified terms, A payments are payments made directly to individuals, such as wages, salaries, and dividends. B payments are payments made to other organizations. Think of bank charges, material costs, and capital repayment. Both A and B costs are included in the price of the final product, but only A payments reach consumers as income. The result? Prices are always being generated faster than the consumer incomes needed to pay them. This is not a temporary imbalance. It is structural. It flows from the way real capital, machines, equipment, infrastructure is financed and depreciated under conventional accounting. As technology displaces human labor, the gap widens. The more productive a society becomes, the less adequate consumer purchasing power becomes relative to total prices. The Douglas Institute identifies the consequences of this structural flaw with precision. In sober truth, there is, in the modern industrialized world, no good reason for poverty, or for a policy of full employment, or for inflation, or for alternating cycles of boom and bust, or for economic waste and sabotage, or for personal indebtedness, or for chronic public debts, or for social turmoil, or for cultural decay. All of these are not inevitable features of economic life. They are artifacts of a defective financial system. Douglas proposed two corrective mechanisms. First, the national dividend, a payment issued to every citizen not as charity, but as a dividend on the common cultural and technological inheritance of civilization. The productive capacity of modern industry is not the creation of any individual employer or employee. It is the accumulated results of millennia of scientific discovery, engineering innovation, and social cooperation. The national dividend distributes the fruits of that inheritance to all who share in it. The second mechanism would be the compensated price, or just price, a mechanism for adjusting retail prices downward by a percentage reflecting the ratio of actual consumption to actual production. This ensures that all goods can be purchased by consumers without the need for additional debt. It is, in essence, a subsidy at the point of sale, financed not by taxation, but by new money issued on the authority of the state. Together, these two instruments would close the gap between prices and purchasing power. Without inflation, without debt, and without the compulsive need for full employment as a precondition of survival. But social credit theory does not stop at economics. It recognizes that the monopoly of credit creation is also a monopoly of political power. As the Douglas Institute states, control of the creation and issuance of money is the power to reward and punish. It is the power to control, or at least exert pressure on state institutions, governments, political parties, and individual politicians. It is also the power to control, or at least heavily influence, public opinion by funding news media, education, and entertainment industries. The logical endpoint of unchecked financial centralization in a social credit analysis is a one-world totalitarian order, the permanent enslavement of mankind through debt. And this analysis takes us to the second part of this video, state banking versus usury. Stephen Goodson opens his historical survey with ancient Rome, and the lesson is stark. During the Copper Age of the Republic, from about 753 to 267 BC, Rome issued its money as a state instrument. Aes grave, heavy bronze coinage struck by the treasury, based on law rather than metallic commodity. The result was unparalleled prosperity. The population grew, trade expanded, debt bondage was abolished. There was zero inflation. In 267 BC, the patrician elite seized control of the mint and introduced privately minted silver coinage. Interest rates soared. Farmers were driven from their land. Wealth concentrated. Within 2 centuries, Rome had descended into the cycle of boom, debt, enslavement, and social collapse that would eventually doom the empire. Julius Caesar understood this dynamic clearly. On returning to Italy in 45 BC, he found the streets crowded with the homeless, dispossessed by usurers. He immediately reduced state debt by 25%, transferred control of the mint from the patricians to government, capped interest at 1% per month, decreed that total interest could never exceed the original capital lent, and abolished debt slavery. For this, he was murdered by 60 conspirators in the Senate. The usurers had their revenge, and Rome's long descent continued. Following the expulsion of Brazilian moneylenders from England in 1290 by Edward I, England entered one of its most remarkable periods of prosperity. The principal instruments of state finance was the tally stick, a split hazel or willow rod used to record transactions, impossible to forge, carrying no interest. The result was extraordinary. As Goodson documents, the average laborer worked only 14 weeks and enjoyed 160 to 180 holidays. A laborer could provide for all the necessities his family required. They were well clothed in good woolen cloth and had plenty of meat and bread. Of course, to be fair, these people also had many menial daily tasks to take care of. The 14 weeks number is also probably a low estimate. Even with this in mind, the craftsmen who worked as little as 14 weeks per year were able to use the remaining time to build England's great cathedrals. The main point to take away from this is that this was a society with enough leisure for genuine culture. It lasted as long as the debt-free tally stick remained the basis of state finance. This era of prosperity came to a violent end in the 17th century. The English Civil War of 1642 to 1648 was not simply a religious conflict between Anglicans and Puritans. Oliver Cromwell's new model army was outfitted and bankrolled by Brazilian moneylenders operating out of Amsterdam, the same community that had been expelled from England 3.5 centuries earlier. Their leader, Manasseh ben Israel, sent petitions to Cromwell requesting readmission to England in exchange for that financial support. Correspondence between Cromwell and a synagogue representative in Germany makes the arrangement explicit. The Brazilians would finance the revolution. In return, King Charles I would be removed and the gates of England reopened. Charles I was executed in 1649. With this act of regicide, by 1656, the first Brazilians were quietly permitted to return. Cromwell had delivered his side of the bargain. Charles II, who restored the monarchy in 1660, was the last English king to issue money in his own right. But he made two fatal errors. He passed legislation permitting the free export of gold and silver and allowed private goldsmiths and bankers to mint coins and pocket the seigniorage, the difference between face value and production cost. These goldsmiths, many of them Marrano Brazilians, who had converted nominally to Christianity, had already been practicing a crude form of fractional reserve banking, issuing gold receipts worth 10 times the gold they actually held, and lending them at interest rates that sometimes reached 30% or more. When James II succeeded Charles and proved resistant to these interests, he was deposed in the so-called Glorious Revolution of 1688, a Dutch military invasion financed, once again, by Brazilian bankers in Amsterdam. William of Orange arrived in England surrounded by a swarm of financiers from that city. His price for the throne was surrender of the royal prerogative of issuing England's money. 6 years later, in 1694, the Bank of England was founded. A private corporation granted the exclusive right to create the nation's money supply as interest-bearing debt. Its founder, William Paterson, boasted openly that the bank hath the benefit of interest on all monies which it creates out of nothing. The Bank of England became the master template. Its power grew rapidly, its tentacles extending across the Atlantic. The American colonies had their own solution to the money problem: colonial scrip, paper money issued by the colonies themselves in proportion to the needs of trade, free of interest. Benjamin Franklin, visiting London in 1763, was asked by Parliament to explain the remarkable prosperity of the American colonies. His answer was simple: in the colonies, we issue our own money. It is called colonial scrip. We issue it in proportion to the demands of trade and industry. We control its purchasing power, and we have no interest to pay to anyone. The Bank of England could not have this. Its response was the Currency Act of 1764, which stripped the colonies of the right to issue their own money and forced them to use English currency obtained through interest-bearing bonds. Within a year, Franklin reported, more than half the colonial population was unemployed. The prosperity of a continent was extinguished by a stroke of the banker's pen. This, not tea taxes, was the primary cause of the American Revolution. The colonists were not fighting for abstract liberty. They were fighting to recover control of their own money supply, to determine their own destiny, for their own liberty. And when they won, the struggle began all over again. From the founding of the first bank of the United States in 1791, foreign banking interests, principally the Rothschilds, made repeated attempts to establish a privately owned central bank in America. They were resisted, sometimes violently. Andrew Jackson dismantled the Second Bank of the United States in 1836 under the campaign slogan, "Vote Andrew Jackson, no bank." He repaid the entire national debt, the only time this has been done in American history, and survived an assassination attempt in the process. Bankers from that point on would cause cycles of booms, busts, and runs on banks. They would use this as backing to propose the Federal Reserve. The decisive moment came on the night of November 22nd, 1910, when a group of the most powerful bankers in America, representing Rothschild, Rockefeller, Morgan, Warburg, and Kuhn Loeb interests, boarded a private rail car in New Jersey with the blinds drawn and traveled in secret to Jekyll Island, Georgia. Edward Griffin's The Creature from Jekyll Island provides a detailed account of the meeting's participants and their institutional affiliations. The participants represented an estimated 1/4 of the world's total wealth at the time, making the Fed's creation the product of the elites, not the people. Senator Aldrich, who led the meeting, would later acknowledge that the meeting's purpose was to design a banking system that would prevent competitive threats to established financial institutions. Over 10 days, they drafted the legislation that would become the Federal Reserve Act. To disguise its true nature, it was presented to Congress as a reform that would prevent financial panics. The very panics the same banking interests had been deliberately engineering for decades. The bill was passed on December 23, 1913, after Woodrow Wilson threatened senators with denial of their Christmas recess. Only a minority of 43 senators supported it. Congressman Charles Lindbergh called it the greatest legislative crime of all ages. Congressman Louis McFadden, who served as the chairman of the House Banking Committee for over a decade, was blunter still. We have in this country one of the most corrupt institutions the world has ever known. I refer to the Federal Reserve Board and the Federal Reserve Banks. The results speak for themselves. Since 1914, the US dollar has lost 97% of its purchasing power. The national debt has grown from $2.65 billion to over $20 trillion. There have been 19 recessions and a Great Depression. The Federal Reserve Board doesn't operate under congressional appropriations, meaning it operates entirely outside the budget process. Full audits of the Fed's operations are illegal under 31 U.S.C. 714, shielding its most consequential decisions from congressional review. Ron Paul argues in his novel, End the Fed, that no institution with that much power over the lives of ordinary Americans should be insulated from congressional oversight. He has also pushed consistently for an audit of the Fed. Its principal shareholders, the Rothschild banks of London and Berlin, Warburg banks of Hamburg and Amsterdam, Goldman Sachs, and JP Morgan, have never changed. The Fed's quantitative easing programs following 2008 injected trillions into financial markets, directly inflating asset prices and disproportionately benefiting the wealthiest Americans who hold stocks in real estate. A 2010 Roosevelt Institute study found that quantitative easing increased wealth inequality by boosting asset prices far faster than wages, effectively transferring wealth upward. Murray Rothbard's The Case Against the Fed argues that the entire structure of central banking is an institutionalized wealth transfer from regular citizens to the financial sector. Napoleon Bonaparte was one of history's most determined monetary reformers. His first act as first consul in 1800 was to establish the Banque de France as a state institution, replacing 15 private banking houses, many of Brazilian ownership, that had run French finances into ruin. Before 1789, France had been allocating over half its budget to interest payments alone. Under Napoleon's state banking system, the franc became the most stable currency in Europe. 20,000 miles of imperial roads were built, financed with interest-free money. A new commercial code, the Code Napoleon, transformed French industry. New universities, schools, hospitals, and public works were constructed. Napoleon refused foreign loans for current expenditure under any circumstances. He wrote, "One has only to consider what loans can lead to in order to realize their danger. Therefore, I would never have anything to do with them." The international banking houses, led by the Rothschilds, financed coalition after coalition against him. The Bank of England's principal purpose from its founding in 1694 had been to generate war debt to destroy any nation operating outside the usury system. Napoleon was eventually defeated not on the battlefield, but by the combined financial power of the London banking establishment. After his exile, the Banque de France was gradually brought back under private influence. And I think this is parallels to today. Just look at how the United States and the Western-led banking system cuts out any countries that try to operate outside of this, bringing war, strife, sanctions, anything they can do. Just look at Iran, Venezuela, and to a lesser degree, Russia, China, and better examples would be previously Iraq, Libya, Syria. All of these countries tried to operate outside of it. Iraq tried to switch to the euro with Saddam Hussein. Libya under Gaddafi had a state bank, and he had the Pan-African the gold dinar. So really, this is a pattern that's been repeating throughout history. You can look back in Napoleon, and we still have that parallel to today. So really, the founding of the Bank of England in 1694 deserves careful attention because it became the template for central banks worldwide. So we can trace it from the Netherlands, from these Dutch, Brazilian moneylenders, coming to England, and then using England's global influence almost covertly behind the scenes to spread this to America, where this conflict has been going on, and today you have the Federal Reserve, and throughout its colonies and such. And so, back to the Bank of England, it was chartered under a deliberately obscure act of parliament, passed in the height of summer when most rural members were absent, with only 42 Whig members present, all of whom voted in favor. The bank's hidden purpose, as Goodson documents, was to lend the crown unlimited sums at interest, creating a permanent national debt that could never be extinguished, secured by ever-increasing taxation on the population. The pattern that followed was consistent. Every war England fought was financed through this mechanism, driving up the national debt and the profits of the bankers. Britain went to war against Napoleon specifically because his debt-free state banking threatened the entire system. The war cost the British public £831 million, over £2.5 billion of which was still outstanding in 1914. The principal of £504 million had over the intervening period increased five-fold as a result of the compounding effect of interest. An astute agrarian and parliamentarian, William Cobbett, at that time perceived what was afoot and wrote as follows. I set to read the Act of Parliament by which the Bank of England was created. The investors knew what they were about. Their design was to mortgage by degrees the whole country, lands, houses, property, labor. The scheme has produced what the world never saw before, starvation in the midst of abundance. And I think this observation is very important because it is the same observation that social creditors saw in the Great Depression, and they wrote about that a lot. And if you want to learn more about that, I would recommend a video by Leather Apron Club, which I will link below, which acts as a very good introduction to social credit through a sort of comic strip story. So that will be linked below. Perhaps the most striking case study in Goodson's book is Tsarist Russia under the State Bank of the Russian Empire, founded in 1860. The statistics are remarkable. By 1913, Russia was the world's largest grain producer, exceeding the combined output of Argentina, Canada, and the United States by 25%. Industrial output was growing at 3.5% per annum, faster than Britain or America. GDP growth averaged 10% per annum in the final 20 years of peacetime imperial rule. Russia had the lowest taxation in the world, direct taxes of just 2.66 rubles per inhabitant compared to 26.75 in Britain. The national debt per inhabitant was the lowest among major powers, 58.7 rubles versus 288 in France and 169.8 in Britain. Child labor had been abolished a century before Britain, and trade union rights were recognized and workers' insurance established. As Goodson writes, His Imperial Majesty Tsar Nicholas II and his state bank had created a workers' paradise that was unrivaled in the history of mankind. The Rothschild banking network, which had been financing revolutionary movements in Russia for decades, recognized the success as an existential threat. In 1917, the revolution that destroyed it was financed from abroad, by Wall Street banks, by Kuhn, Loeb & Co., by Jacob Schiff. The Soviet Revolution was, in Goodson's analysis, fundamentally a Rothschild asset-stripping operation. Russia's gold reserves were systematically looted and transferred to Western banking vaults. Goodson gives significant attention to Douglas and the social credit movement. After the First World War, Douglas dedicated himself to propagating his monetary reform proposals internationally, lecturing in Australia, Canada, Japan, New Zealand, and Norway. The movement gained significant traction in Britain itself. The Green Shirts, formerly known as the Social Credit Party of Great Britain, took to the streets of London in the 1930s under the leadership of John Hargrave, marching in formation and using direct action to draw public attention to monetary reform. They were a visible and organized presence in interwar British politics, and their green uniforms and disciplined street presence made them impossible to ignore. Douglas was not always in full agreement with Hargrave's methods. He preferred education and analysis to agitation. But the Green Shirts represented the popular energy that Douglas's ideas had generated among ordinary working people who understood instinctively that the financial system was rigged against them. In Alberta, Canada in 1935, the Social Credit Party won control of the provincial government. Though federal constitutional constraints prevented full implementation of Douglas's proposals, Alberta introduced its own prosperity certificates, a form of state-created supplementary currency. However, this would not go too far, and the Social Credit Party would linger for a while, but ultimately would not be able to implement much of the full social credit policy. The story was different, however, in Japan. After a lecture tour in 1929, Douglas's ideas were enthusiastically received by the Japanese government and industry. All his books were translated into Japanese. The Bank of Japan was reorganized along state banking lines, and the results were dramatic. Between 1931 and 1941, Japanese manufacturing output rose by 140%, national income by 241%, and GNP by 259%. These growth rates exceeded those of the entire industrialized world. The international banking establishment spent £5 million, equivalent to over $300 million today, to counter Douglas's public education campaign. When the National Socialists came to power in January 1933, they inherited a country with 7.5 million unemployed and a completely ruined economy. The monetary reform program drew heavily on the work of economist Gottfried Feder, who had been teaching since 1919 on the abolition of interest servitude. The NSDAP's financial program, as stated in its official publications, centered on breaking the thraldom of interest, nationalizing the Reichsbank, financing public works through non-interest-bearing state bonds, and creating a national bank for interest-free development loans. Initially, the Reichsbank remained under the influence of Hjalmar Schacht, who was secretly reporting Germany's financial position to Montagu Norman, governor of the Bank of England. It was only in January 1939, when Hitler dismissed Schacht and made the Reichsbank unconditionally subordinate to state authority, that Germany can be said to have had a fully authentic state bank. The results of even the partial state banking of 1933 to 1939 were extraordinary. 1.4 million new homes were built between 1933 to 1937, with each requiring a garden and built up to the highest standards. Rent was also capped on these homes, and interest-free marriage loans were offered with debt forgiven per child born to newlywed couples. How this would work is, with each child, the debt would be forgiven 25%, so when you had 4 children, the debt was wiped entirely. Free education and universal healthcare was provided. Trade grew significantly, 50% of foreign trade conducted via barter by the late 1930s. Major infrastructure investment, including 2,400 miles of autobahn by 1939. Industrial production surged, coal plus 85%, energy plus 76%, iron ore plus 45%. There was also the Strength Through Joy program, which was a worker welfare program that offered leisure benefits, including cruises to exotic destinations, which was available to workers earning under 300 Reichsmarks per month. This is notable given that cruise ships carrying these workers were reportedly denied entry to British ports. Unemployment fell from 30% to near zero by 1939. National income rose 43.8% with inflation under 1% annually. The GDP doubled in around 6 years at 11% annual growth. And defense spending was modest until 1938 to 1939, challenging the narrative that rearmament drove this recovery. Goodson's conclusion was, the Germans were now the happiest and most prosperous people in the world, fully employed and enjoying one of the highest standards of living. This success was achieved by the hard work of the German people and with the support of an honest money system not based on usury or the gold standard. As with Napoleon, the international banking establishment recognized this as a mortal threat. In Goodson's analysis, it was the establishment of Germany as a genuinely usury-free state that triggered the Second World War, not territorial disputes or military aggression. Goodson closes with 3 contemporary examples of state banking in practice. The first being North Dakota, the only U.S. state to accept the offer of a state bank in 1919. While every other U.S. state experienced budget crises and rising unemployment, North Dakota maintained the lowest unemployment rate in America, consistent budget surpluses, and GDP growth of 93.4% between 1997 and 2010. In September 2012, North Dakota had a budget surplus of $1.6 billion. During the period 2000 to 2011, personal income per capita increased by 127%, from $20,155 to $45,747, while the national increase was only 37.4% over the same period. Its Bank of North Dakota provides low-interest loans to farmers and small businesses and returns all profits to the state. Another example is that of Guernsey. In 1816, the island was near bankrupt after the Napoleonic Wars. Its committee devised a simple solution. Issue £6,000 in £1 notes, debt-free and interest-free, to finance public works. The experiment was so successful that Guernsey went on to finance schools, roads, and civic buildings through the same mechanism. Today, Guernsey has no national debt, no external debt, and one of the highest standards of living in the world. The third example is that of Libya under Gaddafi. The Central Bank of Libya operated as a genuine state bank under Muammar Gaddafi. Libya had no national debt, no foreign debt, and foreign exchange reserves exceeding those of Britain and Canada. Its citizens received free education, free healthcare, free housing, interest-free private loans, and a share of oil revenues directly deposited into their bank accounts. Life expectancy was the highest in Africa. In 2010, Gaddafi announced the creation of a gold dinar to replace the dollar for oil transactions. He was overthrown in part by NATO in 2011. Again, the social credit framework helps us understand why these patterns repeat so consistently. The financial system as it currently operates does two things simultaneously. First, it creates an ever-widening gap between prices and purchasing power. This forces consumers, businesses, and governments into perpetual debt, borrowing from the banking system to make up the shortfall. Every loan creates money, and every repayment destroys it. The system requires continuous expansion of debt simply to function. When debt expansion slows, depression follows. Second, the monopoly of credit creation concentrates wealth and political power at the apex of the system. Those who control the issuance of money can reward compliant governments with cheap credit and punish resistant ones with financial crises. They can fund media, universities, and political parties to shake public opinion. They can, and historically have, financed wars to destroy nations that operate outside their system. The social credit solution, the national dividend, and the compensated price addresses the first problem directly, closing the gap between prices and purchasing power with debt-free money issued as a public function of the state. The state banking tradition addresses both problems. It removes the credit creation monopoly from private hands and places it under accountable public authority while directing the proceeds of money issuance towards the genuine productive needs of the community. As the Douglas Institute concludes, whatever production is physically possible and desired by the population could be made financially possible. That is the core claim of social credit. It is not idealism. It is the recognition that the gap between what a society can produce and what its people can afford is an artifact of financial accounting conventions, and that it can be closed by a deliberate, technically straightforward reform of these conventions. The history we have surveyed spans over 2,000 years. In every age, the pattern holds. Where nations controlled their own money supply, Rome in its Republican prime, medieval England, Napoleonic France, Tsarist Russia, National Socialist Germany, Japan in the 1930s, North Dakota, Guernsey, and even Libya, the people prospered, debt was manageable, taxes were low, unemployment was minimal or non-existent, and even more than that, culture flourished. Where private banking interests seized the control of the money supply, whether through the Bank of England in 1694, the U.S. Federal Reserve in 1913, or the IMF imposed structural adjustments of the late 20th century, the people were progressively impoverished, indebted, and enslaved. C.H. Douglas identified the precise mechanism of this enslavement with engineering clarity. Prices always exceed purchasing power, and the gap is filled with debt. The remedy is equally precise. Issue sufficient debt-free money as a national dividend and a price compensation to close that gap permanently. Goodson documented the historical confirmation of this diagnosis across 3 millennia. The question is not whether this reform is technically possible. It is politically possible. It has been done. It works. The question is whether the will exists to do it again, and whether the people can be sufficiently informed to demand it. As Douglas himself wrote in his letter to Adolf Hitler in May 1939, the struggle over monetary reform represents a conflict between those values cherished equally in the so-called democracies and their artificially created antagonists. The fundamental conflict between the policy of freedom and the policy of domination that social credit analysis sees running through all of recorded history. That conflict is not over. It is, if anything, reaching its culmination. Every generation has faced this choice between monetary sovereignty or debt servitude, and most have lost it without ever knowing the battle was even being fought. This generation has no such excuse. The analysis exists. the historical record exists. What remains is the will to act on it.